Sometimes things can be too good. Last Friday, the Department of Labor released an employment report that can only be construed as being very good for the economy. Included in this report was a disclosure that wages had increased by 2.9% on an annualized basis, providing real wage increases for workers. So you'd think that if consumers have more money in their pockets and that over 80% of corporations beat profit expectations, that the stock market rally would just keep rolling along. Well, you'd be wrong about that. Investors construed the increases in wages as the prelude to higher inflation. And higher inflation would beget higher interest rates. And investors are not wrong to be worried about this. We have said that higher interest rates were one of the biggest threats to the stock market rally. If interest rates rise, then valuation measures like price-earnings ratios would have to come down. So you could have a situation where profits went up, but stock prices came down. However, we don't believe that this nascent correction is the beginning of a bear market or that a recession is around the corner. In fact, we think that a correction can be healthy for the market and can provide opportunities to make investments at more reasonable valuations. With the recent run-up in the stock market, stocks have simply fallen back to levels where they were just a month ago when many investors were concerned about valuations. So while we are looking for new opportunities, we will also continue to look at pruning positions that have risen substantially in the last 2 years and may still be trading at lofty valuation levels. We're also not panicking over the sharp downturn over the past 2 days. Just like we don't think it's a good idea to buy something just because it's gone up in value, we don't think it's a good idea to sell something just because it's gone down in value. In other words, we're not jumping out of any windows yet. On the other hand, my office is on the first floor.